Welcome to our latest MGO investment update. Take that screen back. There you go. You got our presentation today is going to be led by Michael Moskal, our Director of Investments. And you have all those people on the screen. We have a full house today. So Brad, Justin, Parker, and myself, Paul, will be chiming in along the way and offering our opinions and comments as we go. With that, we'll turn it over to Michael.
Thank you, Paul. And hi again, everybody. And it's a fun week this week. It's Fed week this week. The Federal Reserve meets tomorrow and Wednesday, decides what to do with interest rates, which is one of our themes for today. We have 4 themes for today. One will kind of touch base on the Magnificent 7 stocks, of course, which are the big stocks everybody knows: Apple, Meta, Nvidia, Amazon, Tesla, Google, Microsoft, that have been kind of driving markets the last couple of years. Part of this AI revolution, which is a big theme that we have. We've been writing about it for probably about a year. We think the whole AI revolution is going to drive the economy and create efficiencies and all kind of good stuff for us over the next generation here. And then lower interest rates. Are we going to have lower rates or not? That's a big question. What do you guys think? Lower rates coming?
Yeah, I think they're coming. I think they're coming. Probably before the end of the year, we'll see at least a initial move down.
But it does Wednesday. So, Brad, what do you think? Are they cutting Wednesday, or are they going to be waiting or not?
No, not Wednesday. I think they'll probably wait till later this year, probably somewhere around the September timeframe.
Yeah, I would agree. Definitely not cutting this next meeting here, but yeah, I think probably in September.
Yeah, I think they'll cut in September, and then I think probably you'll get at least 1 or 2 more after that. So 2 or 3 rate cuts this year.
Yeah, I think that's our consensus here. I think we all feel the same, that the Fed usually doesn't surprise markets. Markets are not expecting them to cut Wednesday, but there's a very high probability. I think it was 90% chance now the markets expect the Fed to be cutting in September. So the Fed does not like to surprise the markets. It usually shakes things up. So the odds are probably high we will see a September cut. The Fed's been telegraphing this since April. The cuts are coming. And then we'll touch on the election a little bit and what that means to the investment markets. Let's take a quick look at market scorecard through June 30th. And in bold on this chart are sort of the broader stock market. The NYSE Composite Index, which all stocks listed on the New York Stock Exchange, is about 2,000. And that was up close to 7% through June 30th. Last year was a good year. Of course, 2022, you see a lot of negatives. Markets were down in 2022 for just about all asset classes. Bonds are negative this year still, coming off a decent year. Brad, you had made a comment about 2022 with bonds.
Yeah, 2022 was the worst year in the history of the bond market. You had a big decline, 13.4%. So if you have a balanced portfolio, a lot of times when your stocks don't do well, your bonds hold up, but that didn't happen in 2022. So that's why almost everybody had a rough year in 2022. There were only 2 asset classes that were actually up: gold and oil. So not a whole lot did well in 2022. There's an upside to that, and that is now you get some yield on your fixed income. So a lot of the fixed income opportunities out there will yield you 5-6+%, whereas previous to 2022, you were looking at 2 or 3%. So we're actually getting a little bit of yield on that fixed income portfolio now.
Yeah, that's a really good point, because prior to 2022, really from 2009 to 2021, when the Fed had pushed rates near zero and kept them there almost the whole time, there's a couple times they raised rates a little bit, but pretty much rates were in that zero bound range. It was hard for fixed income investors, including my parents. My parents are in their late 80s at this point, but even going back 10 years ago in their late 70s, I had to have them more invested in equities than I probably would have liked to, just because I couldn't get any yield, any kind of yield on fixed income. So that is a good point. We are getting, starting in 2022, we started seeing rates at 5%, and rates were actually close to 6 on some corporate for a while. So as much as negative, you see some negative sign in here on actual bond prices, the yields are actually, in a decent place right now. And that does mean, by the way, if you look at the typical like 60-40 investor, where 60% is invested in equity, 40% in bonds, you're looking at returns overall broadly, overall in the 4% to 5% range for the first half, depending what indexes they were invested in. So our equity ETF portfolio this year is having a good year through June 30th, up almost 11%. The Dow's been a drag because, again, what's been driving performance, and the one below the Dow Jones is the S&P 500, which at this point is 45% in market cap with technology stocks. And tech is driving this year. The S&P was up 15% through the first 6 months. The Dow Industrials is heavily weighted towards industrials and other kind of non-tech stocks, and that was up almost 4%. Dow Jones Global XUS is foreign stocks, up 4%. Brad had mentioned gold. Interesting on this chart, by the way, gold's the only major asset class that had positive performance 22, 23, and so far in 24. So it's kind of been a haven. It did what it's supposed to do in 2022 and be a haven against down markets, but it's also doing well the last couple of years. Probably, because there's been a lot of printing of money, and gold is typically a proxy on currencies. So if people think that currencies are going to weaken down the road, they will be buying things like gold and even Bitcoin, just sort of becoming a little bit like a gold proxy, only with a lot more volatility to it. But you can see 2022 down 78%. That's tough, man, to come back from that. But, up 156% in 23. It's up 70% this year. And Bitcoin's a legitimate asset class now. There's been people who are calling for it to go to zero. It's not going to go to zero. Wall Street has a number of ETFs that invest in Bitcoin. And once Wall Street was in it, starting the first quarter of this year, it made it legitimate, officially. Any other comments, gentlemen, on this chart?
Nope.
Nope.
And this is a look at the last month. So we looked at through June 30th. What's been going on in July is just about the opposite. So the worst performing sectors are actually the technology sector and communication services, which communication services is made up about 25% of Google and Meta, part of the Mag 7. But all these other sectors have been actually doing well. And that's part of our broadening out theme that we've been writing about the broadening out theme since the beginning of the year, trying to broaden out investment portfolios and invest in cheaper sectors like real estate, financials, industrials, and so on this chart. Just to look back at 2023 again, we had a big dominance of the Magnificent Seven stocks that made up almost 30% of the S&P 500 at the time, and they still not quite there, but they're about that. And the chart on the right side shows the returns for 2023. And again, very heavily dominated by the Magnificent Seven, which it should have been, because that's where all their earnings were in 2023. These big 7 companies are the leaders in the AI revolution right now. We think that you're going to see others, and already we're seeing others that are jumping on this. I had an interesting article I read. This is on UPS. So it's not just the Magnificent Seven that's being able to participate and benefit from artificial intelligence. So UPS created an AI software called Delivery Defense. And when they deliver packages to your house, what they're doing now, the AI and machine learning technology is looking at attributes such as location, loss frequency, return volumes, delivery attempts, and coming up with a algorithm or logarithm that's telling the driver whether they should drop it off at the house or take it to the UPS store. Because if there's been too many thefts, it's to combat theft. So if the AI says no, there's way too many thefts in that area, drop it off at the UPS store. So the driver will take that package and drop it off at the UPS store and put a sticker on the house and say your package is at the UPS store. So that's just one example of a non-Mag 7 company that's using AI, but there's many, many, many thousands of these that are out there that are broader, companies using this. 2024, similar kind of story. Now, the chart on the left shows not just the Magnificent Seven, it also includes Eli Lilly in there, Berkshire Hathaway, JP Morgan. Those are some of the bigger companies in the S&P 500. That's the top 10% of market cap. But they make up a big percentage of the S&P 500 right now. So about 34% is just those 10 companies. So one or two things has to happen. Either you have to have a broadening out to keep the rally going, because you just can't have 10 companies that are driving everything forever, or you have a correction that happens. And we're seeing a little bit of both happen right now, with the broadening out happening, with the unloved sectors going up and some of the more overbought sectors coming down in the last month. This is fascinating on the bottom right-hand side, guys. I mean, this is just amazing, right? NVIDIA, this is the value of NVIDIA in stock market terms, the market cap. NVIDIA is worth more now in stock market terms than the entire stock markets of UK, France, and Germany. I mean, it's just, to think about that, it's just funny to me that you have one company that's worth more than all these, those are big countries. Those aren't little countries. Those are big countries. But their stock markets, NVIDIA is worth more than all those stock markets combined. Now, that doesn't continue forever. You can see the chart goes straight up, and it doesn't mean NVIDIA is not a good company to invest in. It just means it's probably not going to go up at that pace for foreseeable future necessarily.
At what point is there a reversion to the mean?
That's the tough question, right? The when is always the tough thing. So years ago, John Templeton, who started Templeton Funds, he's passed away many years now, but he was actually the first billionaire on Wall Street, so to speak. Back when there was no billionaires, and that was back in the 1980s. If you were worth $1 billion, nobody was $1 billion. Now they all make $1 billion. Okay? But John Templeton was one of the first ones, and he started his Templeton Funds from scratch in the 1950s, I think, or maybe 40s. He started Templeton Funds with nothing. He borrowed money from his father-in-law, I think it was. But he was one of my first mentors in the 1980s. I got a chance to talk to him a couple times, but one thing that always stuck to me for those years, where he said, I can tell you all the cycles that are going to happen. I can tell you the stock market cycles and the bond cycles and the economic cycles and the value cycles and growth cycles. He goes, the only thing that I could never figure out in my 70 years of investing, because he was in his 80s at the time, I think, is one thing I could never figure out is exactly when's those cycles change? When's the value cycle come? When the growth cycle come? Because if you look at his track record, he was early a lot. He was buying in Japan back in the 60s. When Japan was kind of junk. What they were producing was considered to be junk. But he bought back in the 60s. He made a ton of money in the 70s and the early 80s. But he had to wait. He had to wait, probably a good 6-7 years before his investment came to, but he made it big in Japan.
Yeah.
But he had to wait. He was always a little bit early. So sometimes you just can't get the timing right on these things. But when you see parabolic moves on stocks like NVIDIA, and I'm not saying NVIDIA is going to go down anytime soon necessarily, but it can't sustain that kind of straight up move forever. No asset does. But at some point in time, yes, of course, it has to correct.
It sort of reminds me of the late 90s when you had the technology, you had the tech bubble, and all the tech stocks were just going all up all together. The difference, though, is NVIDIA makes a lot of money, and a lot of those tech stocks that were booming back during the tech cycle were not making money. NVIDIA is making a lot of money, and they're making the chips that are driving the AI revolution. So I think it is interesting that it's gone up so much. Again, hard to argue that you may not have a reversion to the mean, but it certainly makes an argument for why NVIDIA should have done so well.
Yeah, for sure. Absolutely. When they own 85% of the GPU market, the chip market for AI, it's not hard to figure out why they've done so well.
Right.
But that doesn't always stay that way. So you go back to the late 90s, Microsoft and Cisco Systems, the tech company, were dominating. Cisco, I think, had the same kind of market share with what they were doing for the guts of the dot-coms. They were making the internals for the internet. And so, but there's always competition eventually that comes in, and always somebody else is going to get in there eventually because the profit margins are high. That's what capitalism is.
Mm-hmm.
But who knows? But no, NVIDIA is going to be a great company, just like Microsoft when the late 90s boom, but still a great company now. And so is Cisco, still great companies.
Yep.
This is a chart showing the broadening out move, broadening out meaning other companies that are participating in the stock market gains. We had that first move, which is when we started writing about it. back at the end of last year, all the way through the first quarter of this year that you had. And when this chart is going up to the right, it means that other stocks are participating than just the Magnificent Seven stocks. So we had that first move, kind of chop around here, and then we just had this move in July so far. This move that's been happening, this big tick up with these other stocks participating, which is good. It's very healthy for the market. Markets are healthier when you have a lot of participation. You have a lot of companies, lots of stocks that are going up. Markets are weakest when you just have a few stocks going up. So we want a strong market. Another thing that supports the whole broadening out theme is the evening out of earnings with the S&P 500 companies. This chart's looking in the blue. The blue on this chart are the Magnificent Seven companies and their year-over-year earnings growth. Okay, this is not stock market. This is their actual earnings growth that they have year over year. And you can tell, it's Brad, like you said, we had some big growth from NVIDIA and the others. It's been massive growth. But no companies, history tells us no companies can grow at 40% every year. It just doesn't happen. Competition comes in, they maybe overbuy. One of you had mentioned earlier about perhaps the overproduction of capital spending. The overspending that's going on maybe now in the AI a little bit. And, those are the kind of things that start eating away at your earnings. But it looks like if you compare the Magnificent Seven to the other S&P 493 companies, we have an evening out of earnings. That's what the expected earnings for Q4 of 2024. Again, which is very healthy for the market to have that kind of activity happen. Yes. Well, I think the battle's over. This was something we used this earlier in the year with Congress battling Jay Powell because he kept saying he wasn't going to be cutting rates. And Justin, what do the politicians want?
Rate cuts.
They want rate cuts. Why do they want rate cuts? Lower rates means what? It means people borrowing, right? People buy houses, they buy cars, they
boost the economy.
boost the economy, because what the politicians want the most is for you and me to walk into that voting booth and push the button that says, keep this person in. That's what they want. So how do they do that? By having us feel good about things, our economic situations, the economy looks good. They want all that to happen. So they want rates low. They want to put money into the economy through printing money oftentimes. So they put a lot of pressure on the Fed. The Fed is supposed to be independent, and it kind of is. But I would say that Fed is very influenced by Congress at this point.
And they like to kick the can down the road for the next administration to deal with, probably.
Yeah, and as long as they can continue to do it, that's a good point. As long as they can continue to do it, they're going to do it. So we like to set our alarm and our date watches and phones to block off when Jay Powell testifies in Congress, which he just did recently in the last month. And in April, he had one too. So a couple times a year. And it's interesting. We want to do that because it's interesting to see where the pressure is coming from the politicians, because they ask him questions, they make comments. And really starting in April, they were putting a lot of pressure. Going back to 2022, the pressure was coming from inflation. And they were saying things like, Mr. Chairman, inflation is raging. My constituents can't buy food. Food costs are too high. You've got to get inflation down. So Jay Powell and the Fed raised rates to get inflation down. And then now we're a little bit different because inflation has come down. They did a nice job. So now the pressure is coming more from interest rates because of what we just said. So now the talk is, Mr. Chairman, Jay Powell, you got to get interest rates down so my constituents can buy houses and cars, and my small businesses can take loans out and expand. And they're not wrong, by the way, the Congress people, they're not wrong. It's just we'd like to see where the pressure is coming, because probably the Fed acquiesces to that. And thus our belief that the Fed's going to be cutting rates in September. And Parker, we'll see if they keep doing it. Usually they start a rate cutting cycle. You're right. They continue to do it. They don't just cut one time and just not do anything after that.
Right.
This is kind of a fascinating chart, and we all made comments on this chart. Where do you think we are, Parker, in the cycle? This is the business cycle. This is the business cycle. Early in the cycle, mid cycle, late in the cycle. We're certainly not in recession. I think we all would agree on that, right, guys?
Right.
Yeah, I'd say we're probably somewhere between the mid and late cycle. Probably in between there.
What do you think, Parker? I mean, Justin?
Yeah, I would agree. Probably right in the middle of mid and late. Of the three, though, I would probably say we're in the late.
Okay.
Yeah,
I'd
I'd
agree.
agree. Go ahead.
Oh, go ahead, Paul.
I agree. We're in the late, and it doesn't necessarily mean we're near a recession at this point, because we could stay in the late part of the cycle for a while. But I think we're getting there.
And I'd agree with Paul. I think we're probably in the late, and I don't think recession does not look likely. Looks like the Fed has sort of threaded the needle.
Yeah, and this is we all agree on that. So somewhere mid late, certainly not early. We've been in the economic growth, we've been in this growth cycle for a while, and certainly not recession. We had a GDP number that was up 2.8% last week, so we're nowhere near a recession. There are signs of slowing down for sure. There was I think McDonald's reported earnings this morning, and they were under consensus because they said that they see a slowing down in the consumer spending. Okay, and that's a big McDonald's is a big thing. There's a lot of people that go eat at McDonald's, so McDonald's is one of those companies that is important to watch. As are the shipping companies like UPS. We mentioned UPS. Those are important companies to look at, because when they start seeing slowing, they start seeing people buying less. If people are going out less to eat at McDonald's, that means they're probably staying home and making food. And that means probably they're just reining in their spending a little bit. So, and again, it doesn't mean that we jump into recession next week. It just means those are signs that we have to look at and say, okay, we're probably starting to see a little slowdown going on. And that makes a big difference, because if you look at the sector on this chart, what it's showing is the sectors in the S&P 500. And the pluses mean that's when those sectors do well, and the minuses are when they don't do well. And it's not exact, okay, guys? So it can cross sectors in here, but typically this is historically what happens. So the ones that are pluses early in the cycle, there's a lot of them in there. But if we are going into the mid to late part of the cycles, then you start seeing perhaps technology slowing down a little bit, real estate pick up, which is ironic because that's the best performing sector this last month is real estate. Consumer staples. So those are the companies that, like Procter and Gamble's of the world, that people still have to buy diapers and toilet paper and paper towels no matter what's going on. Energy tends to do well in the late part of the cycles, as does utilities. So we are watching, and that's also, again, all these are supporting what we've been doing with your investments as far as investing in different sectors, broadening out a little bit, because if we are entering
last week, the utility sector, and they're right now they're the second best performing sector. They overtook tech last week, up over a little bit over 13%, and that's part of, we do have an overweight to utilities in our portfolios as well.
Mm-hmm. Yeah, for sure. And utilities, for a number of reasons, by the way, the cycle performance is good. And also utilities are part of the whole data center revolution going on with AI. AI needs these whole data centers in order to produce the power for their products. So utilities are one of those sectors that's going to benefit from AI too. All right, election. These are all election years since 1950. That's the blue part of the graph. 2024 year to date, of course, it stopped in January. This is the chart that goes back then. But if you look back at all election years since 1950, we're in that part of the cycle right now. We're getting into this part of the cycle in August, September, October, leading up to the election. That's sort of this. Markets haven't typically gone a whole lot. Doesn't mean it has to happen this year, but typically, historically, we would see sort of just a flat kind of market, even flattened down a little bit going into October, leading up to the election. And then fourth quarter has typically been very, very good, after the election. So after the election, you see the market take off. Again, there's no promises that happens this year, but that's been the historical performance. And then longer term, you've been talking a little bit about short term, longer term, which is part of our investing strategy. We have to look part of what we think is going to be happening longer term too. Interest rates for longer. What do you think, gentlemen?
Yeah, I think so. I mean, we're not going to go back to the zero rates that we lived with for what, long time. We're going back closer to the historic norms. Well, we pull back a little bit from here, but it's kind of more to what it's been. If you look over the last 100 years, maybe the 3.5%, 4% is kind of more the longer term average.
I would agree with Paul, which is part of what makes fixed income look pretty attractive at this point.
Yeah, I'd say higher for longer. Definitely not going back to zero.
Yeah, definitely gonna be higher than what we saw the past decade.
Yeah, the last decade we had the zero bound because it wasn't exactly zero.
Right.
You know, between rates were 0 to, depending what you're looking at, 0 to 2. You know, mortgage rates were in the 2s. You know, which I'm sure there's some people on this call that probably locked in mortgages in their 2s. You know, so I don't know if we're going to see that again. You know, that was an unusual situation because usually if you push rates down to those kind of levels, you're going to stoke inflation very quickly. You know, that didn't happen partially because of the second theme, which is the graph that you see, this puzzle of the world and people grabbing a piece of their puzzle and walking away, you know, which is the deglobalization, you know, which is the opposite of what we had going really since the wall fell in Eastern Europe when that wall fell. And, you know, Ronald Reagan told Gorbachev, Mr. Gorbachev, tear down this wall, you know, and the wall fell and the Soviet Union collapsed. We had a big globalization move happen for, what is that, 30 plus years, you know, where goods were moving to the most efficient parts of the world to be made and done. Supply chains were done globally, you know, again, for cost purposes and for efficiency purposes. So you had a lot of participation, a lot of cooperation between countries, among countries. We sort of have a little bit of the COVID kind of changed some of that, you know, where now you have, even with our chip stocks, you know, the chip companies. So, you know, AMD, NVIDIA, Intel, I think it was Intel, right? It was Intel that's building in Columbus, Ohio.
Yep.
You know, the government gave Intel $28 billion of tax grants in cash to say, stay here. Don't go somewhere else to make your chips. Stay right here in the US. We want you here. So that's a big theme that's going to happen longer term. But these are longer term themes that happen. But it does mean that supports also probably, if you're making things not in the most cost efficient places, because certainly labor costs are higher here in the US, that you're probably going to have higher costs of things, which means a little higher inflation, higher interest rates. And that's part of that theme too. Value stock rotation, again, is just you know, we've been talking about the broadening out. AI is a huge theme for us, the metaverse. That's gonna pervade many areas of our lives, you know, including, by the way, sports. You know, and I'm thinking, you know, we're season Browns holders. Okay, we have season Cleveland Browns tickets for football. You know, even like something like the Cleveland Browns. So in January when it's -3 degrees here, we have tickets. You know, maybe instead of going downtown to the stadium to go see the game, this is in the future, by the way. You know, like we can put our goggles on, like the bottom left corner here. We put our goggles on in our haptic suit, sit on our couch, and feel like we're actually at the game. You know, where you can actually have your avatar at the game. Would be like you almost feel like you're in the stadium there. You can even dial your suit down to 10 degrees if you want to be cold. You know, but you'd save a lot of cost, of course. You know, because maybe the Browns would charge $19.99 for that kind of seat. But you could smell it. You know, again, these haptic suits are real. You know, you could smell the stadium smells, hot dogs, and whatever else, beer, whatever else you smell. But that's just one example. But it's going to pervade, I think, a lot of our things. In this down to the left-hand corner in the movie called Ready Player One, kids went to school in the metaverse. In order for towns to save and communities to save money, they didn't have physical buildings. The kids would put their suits on in the morning and go into the metaverse to go to school. And they have lockers in there, and they'd have, you know, have classrooms and teachers, but it would all be in the metaverse. So some of that's going to happen. It doesn't mean everybody's doing that. It just means that's an option potentially down the road. All right. And that, I think, concludes this video. Any last comments you have, guys?
No.
I think so.
No? All right. Well, thank you again, everybody, for watching and listening. And we will be back to talk soon with you.
And feel free to reach out to us anytime you have questions or concerns about your account. We're always here we want to hear back from you. Thank you.